Hi, Matt McAleer, President, Director of Private Wealth, Cumberland Advisors. August 2nd, closing out a nasty week equity-wise. Back half of this week had some real selling pressure. Again, not something we don't deal with from time to time. Remember in April, we had a 5.5% S&P drawdown from the previous high there. NASDAQ here pulling back 10-11%. Again, it's not the number of 10-11%. It's how quickly. Remember, just July 11th, we were making year-to-date highs in the NASDAQ. So that trade got crowded. That trade got over-owned. Some of those buyers need to cough out, to put it nicely, some of the stock that they bought late. The market will always punish the late buyers. We know that from decades worth of trading, and you know that yourself. What are we doing in our portfolios, and what are we looking for? U.S. core portfolio, which, by the way, our portfolios had a dynamite July because they are a bit diversified. So we were able to take advantage of some of that strength in small cap, in mid cap. Unfortunately, these last couple of days, we gave back some of that performance. So how do we go into next week? U.S. core. Want to still get a little heavier in growth. That may seem odd, seeing the pressure that we've seen on growth. But the growth names we use in core, and we primarily use VUG, which is the Vanguard Growth Fund, is trading above its April-May low. So when we pulled back in April and then rallied, that was a very strong breakout. We're interested in stocks, sectors, and industries that can remain above that April-May low. So in core, we didn't do anything. We're sitting about 5% cash, so we're a little thin there. Over in US ETF, we were sitting at about 10% cash. We were a little bit more aggressive. So earlier this afternoon, we bought some SPY-G. That's the S&P 500 growth. Remember, in heavy sell-offs, I want to be broad. I don't need to pick individual securities here, but if I find some value in a broad area, I want to take a shot. Why SPY-G? SPY-G came back to the roof. That's an old trading term. Had a tremendous breakout in May, ran very hard, and now has retraced back to that May breakout. I'm willing to swing the bat a little bit here. We didn't take a much larger position. We added about 3% to our SPY-G position, took it up to 13%. Still have about 7% cash in that portfolio. Tactical trend, didn't do anything with it today. Really have our eyes on a number of mid caps, especially in the industrial area, that have pulled back to attractive areas. We'll take a little bit more of a swing at individual securities, individual stocks, obviously in our tactical trend where we own individual stocks. So we're sitting there with about 5% cash, but a 20% T-bill position that really we look at as a parking place for the time being. So we have some firepower going in to next week. But again, what we really want to see, what we really want to concentrate on, what I'll go over this week when I'm reviewing names, is names that are still trading above that powerful May breakout area. If stocks and sectors have fallen down below that April-May consolidation, it's going to take a little more time. It's a little tougher for them to turn around and start to rally. They can still do it, just a tougher trade. So let's concentrate on names that rallied wonderfully and now have just pulled back maybe 5, 6, 7% to their previous breakout spot. Those are the kinds of things I'm looking at. I'm sure you're looking at a number of names, a number of sectors, number of industries. We'll continue to go over them every Friday. Very strong week in bonds. So let's shoot to the moose.
Hi, it's John Musso. I'm the CEO of Cumberland Advisors. It is Friday afternoon on August 2nd. This is the bond report. A day like we haven't seen in a very long time. Yields dropped across the board. Looking at 2 years down 50, 5 years down 45, 10-year 40 basis points down in yield, 30-year bond down 35 basis points in yield. What caused this? Jobs report today, mostly. The market was expecting about 175,000 in jobs. It got 114,000 in jobs. And it also got an uptick in the unemployment rate to 4.3%, which really, depending on what measurements, can tell you that you're inching certainly closer to a slowdown when you look at the rise in unemployment this year, which has gone basically from 3.7% all the way to 4.3. So pretty hefty. If you look at municipal bond yields on the same chart, you can see they're down only a fraction. Why? Because everything doesn't move like treasuries. Treasuries move immediately. Everything else plays catch up. It does create value in other markets like corporates and tax-free bonds. For example, the yield ratio on the tax-free AAA bond to treasuries has gone from 67% to 70%. That doesn't make it extremely cheap, but it makes it cheaper than it was, and that's a big movement in 1 week. What started this out earlier this week? We think part of it was Jay Powell talking on Wednesday, Fed's rate decision not to cut rates yet. They talked about wanting to see more evidence on inflation. We will get that in the next week. But what he did say was that they really want to cut rates. And as he got into his talk, bond yields started to drop about 2/3 of the way through his speech, and basically went from a 411 down to a 404 by the time he was done speaking. And that's pretty remarkable. And it says the market was A, maybe expecting a rate cut, B, now they saw a rate cut pretty close in what Jay Powell was saying. One of the big differences is that the stock market rallied vigorously on Wednesday and gave it all back on Thursday. And so it was very easy to have stock slide today with this. We think another thing that has basically brought bond yields down too is not only this week with the softening data, because we've seen other softening data too, manufacturing indices, jobless claims, initial jobless claims higher, home sales lower. We can go on. I mean, all of that is really kind of been baking into the cake over the last few months. We've talked about it here. But on the political front, if you went back to after President Trump's assassination attempt, bond yields had ticked up basically to almost a 447 in that range. That was maybe after the debate performance by President Biden. However, since then, they have tumbled a lot when you look at where they are to 380 now on the 10-year bond. But we think part of it is that once Biden pulls out and Vice President Harris goes into the race, that the chance for divided government becomes a lot more. In other words, you will not have a clean sweep of a Senate, House, and White House. And as we've talked about before, when you have that, and it's divided government, that generally is better for bonds, at least on a relative basis. So we think that has been helping over the last couple of weeks, week and a half. Certainly, that was overwhelmed by the numbers today. So we're kind of in a new paradigm. We're back in three-handle bonds. I think it's important to realize that where the 10-year bond closed today was a 380. It began the year at a 388. It quickly faded. Remember, we went all the way to a 470 back in April when people were concerned about the stronger job numbers and somewhat stronger inflation. Been a big turnaround. And certainly it will be part of the story between now and the election. We look forward to talking with you next week, and we hope you all have a great weekend. Thanks.
Thanks, John. And if some of this volatility, day to day, week to week, is jarring within your portfolios, reach out to us. We'll have a conversation, can review, see what suggestions, what information we might be able to share and be helpful. Enjoy the weekend.